Hey, welcome back to Everything Money. In this video, you will get our thoughts as value investors in looking at Tesla as a company and its stock price. We'll go over future projections, look at the financials using our software and the stock analyzer tool to show you what you should be paying for this company or, in our opinion, avoiding or not paying for this company at the moment. We'll give you our insight as value investors, and Paul and Mo will give you and I, a mindset of how to invest in a company or avoid a company like this. Paul, take it away.
Thanks very much, Seth. Guys, follow us on Instagram, Everything Money Investing, and also follow our personal accounts. I put an awesome picture of one of my dogs, but two, our interview with Mohnish Pabrai, and it was very popular. I got so many comments about my sweater, actually. Not this one, but the one I'm wearing in the picture. So, Tesla. Guys, if you hadn't heard of Tesla, Tesla is an electric vehicle manufacturer in now Austin, Texas, where we just were. What do we want to say about Tesla?
Well, it's funny because right before we started this video, I said, what do we want to say about Tesla? So,
did you say that?
In my head.
Oh, okay.
But I was going to ask you guys, but then I was like, let's just record. So, it's an interesting company. Good cars, great products, lots of legal lawsuits going on with them and their solar. And
two people in this room own Teslas currently. I have one on order, which I don't think I'm going to take.
Phenomenal car. I got the new Model S, for those of you that don't know, and it is a phenomenal car. It is the coolest thing I've ever bought.
So here's the interesting part. We just interviewed Mohnish Pabrai, and he was giving a bull argument for Tesla in a way. I'm not saying go watch the video because it wasn't exactly a bull argument. However, I did say this afterwards. I said, if I was on the fence about Tesla, if I thought, okay, it's selling reasonable, Mohnish's comments about him would have made me buy it because he's very accurate on it. He's very true. He's very smart about the way he's looking at Tesla from that regard.
He said both assumptions could be made and predictions could be made.
All assumptions could be made.
I don't think
that it's overvalued and then or it's undervalued. Yeah, I mean, so we were in Austin, and Paul, when I first got my Model 3, which I had for 3 years, and now I have a Model Y, at first, Mo, it was very rare to see a Tesla.
Yes.
My boys would, yay, well, hey, guys. Now they're just freaking everywhere. And if you go to Austin, they are everywhere. Now, I would say it was funny. I was going to stop Mohnish at one point. I said, when you get to a certain point, I can see Tesla selling 5 to 10 million cars a year. And I wanted to say, you mean out of 14 that are... How many are sold?
Well, that's in the U.S., 14 million new cars. So, correction, it's 17 million new cars in the United States are sold every year. New cars, light trucks, etc. That's not including all the semis, all Seth's tractors, and all those things that he has in his property. None of that.
Right.
Can Tesla sell 5 or 10 million new cars a year worldwide? There's over 50 million cars sold per year worldwide that are new. Okay, I can understand them having 10, maybe 20. I can understand that. To me, and again, the value investor in me, which I was kind of surprised he said this, but the value investor in me says, in order to justify the current valuation, that basically needs to happen. So by the time it happens, it says, okay, today's value is good. So that means in 10 years, 20 years when it happens, today's value is the correct one. Not today's value will grow into that and justify, no, it means today's value. So you're going to be stagnant for those years. Just like the example I give is Bryce Harper, whoever makes $30 million a year, give a high school kid $30 million, give a high school kid say $20 million a year and say, I want everything you make in the future. Okay, it could work out for you, but what's going to happen? He's got to go through high school, the draft, college, go to the bigs, and end up becoming the Bryce Harper for that to happen. It's a stretch to me. And that's the way I look at Tesla. For it to justify its current valuation, it's got to hit home run after home run after home run to even justify today's price. Not 20 years from now price to get a reasonable return. To get 0% return, basically it's got to do that. And that's where I get a little confused.
And as a value investor, we're not really in the game of hitting home runs. We want little rinky-dink base hits.
No, we're in the game of hitting anything around the bases, but we have to pay the right price for it today. We're not going to pay home run money for what hasn't been hit yet. I want to pay single money for what could be a double, triple, or home run down the road. That's our goal. So let's go to our software, our exclusive Everything Money software, and let's go look at Tesla. So we go to the 8 Pillars tab. We type in TSLA.
By the way, Tesla stopped taking orders outside of the U.S. for their Model X and S.
Really?
Yeah. So it's not as they have their road bumps. They're going to have their road bumps. I mean, this is a short-term thing, I'm sure, but
well, keep in mind, by the way, they're already down. They're still already down 25% since November 5th.
Yeah.
Again, anything can happen, but in the short term, like guys, these things don't just always go up, and they don't just always go down.
Right.
They're going to go down, up, down. That's the way it works. It's not so. Anyways, the company, it's no longer a $1 trillion company, but $935 billion.
Sorry.
Current PE 270. There is no 5-year PE because in the last 5 years they haven't made overall money. So our first pillar is we want the 5-year PE under 22.5. It is non-existent. Now, gross margins about 23%, which is actually pretty healthy for a car company. But my understanding is this includes a lot of government money in there.
Mm-hmm.
There is no 5-year return on invested capital. Why? We want it to be above 9%. It's negative because the last 5 years free cash flow is negative. But last year's free cash flow, $2.56 billion, which means right now they're selling for about 37 times last year's free cash flow. We want it to be around 20, 15 to 20 for 1 year. So guys, so far, not a good start. Now, here's the exciting part about Tesla. Let's go to the income statement of our exclusive software. Look at this revenue growth, kids. In 2012, they did $146 million in revenue. Last year, $46 billion. This is huge. This is what gets people excited because all they say is, oh my God, look at this growth. This is going to $500 billion. And it might. It could go to $500 billion. Toyota does hundreds and hundreds of billions of dollars in revenue. Great. It could go there. But will it go there? I don't know. And if it does go there, what's that worth? So let's go to the net income. 5 years ago, they lost $1.4 billion. Last year, they made 3.4. That's a check mark. That's pretty legit. Okay. We're on the right path here. We're getting somewhere better. Again, does it mean for a company to be worth $1 trillion, it essentially needs to make at 15 times $60 billion a year in profit. So using the same ratios, this has got to grow by 18 times. Well, if it takes 18 times this profit to make it justifiable, the revenue, 18 times more of 46 billion would take the car company to, what is that, $600, $700, $800 billion in revenue. Is that reasonable? I don't know.
Not right now, it's not.
I don't think it is right now. That's the point. And if it does happen in the future, you might sit there and say, if I had a crystal ball and God came down and said, Paul, Tesla at its peak will make $60 billion a year in profit, I'd be like, okay, then I'm not buying Tesla. But Paul, just if I say, exactly, I'm not going to get no return on my money. I'm going to pay $1 trillion today for what it needs to do in the future to justify today's price. I don't understand that. That's just like saying, here's a better example. You own a house. It is 2022. If God came down today and your house is worth $300,000, God came down and said in 40 years when you sell it, it'll be worth $1 million. What you're saying then is you should pay $1 million for it today, based on the same numbers. That's the better analogy because people understand that better than the sports.
Here's a quote from Elon Musk. He got interviewed by Time Magazine about getting his Person of the Year.
Which, by the way, love Elon Musk. He called Senator Warren, Senator Karen. Love the guy. He's a brilliant man.
My favorite.
He has great ideas. He's trying to go to space. Don't knock it. Great libertarian. Go ahead.
Tesla's valuation. I've tried to just tamp down expectations, saying I think the stocks may be too high. Current valuation is pretty high, which suggests that the market has faith in future execution of the company, because it's certainly not based on historical profitability, that's for sure.
Okay.
He's right.
He's right. I don't think he's saying anything good or bad about the company. He's just saying, listen, it's not justified off of current and past numbers. It's just it's being done based on future projections. I don't think he's saying anything, but he's saying, what do you say about expectations? I want to temper them.
Tamp them down a bit,
I mean,
because as we know, Mo, they
So
are
the CEO and founder, the biggest hype man of all time, is telling everybody he needs to tap down the.
I don't know if I would call himself the biggest hype man, Paul, but I would say
That's a good point. Maybe
I would say, Mo, that they are definitely in the game of over-promising and absurdly under-delivering at all. Whether they're announcing cars and not making them, announcing products like solar and not getting them done, selling cars in general. Mo, you know our experiences with Tesla buying.
Yeah,
it's not all peaches and cream.
Even when that Hertz deal went through, remember that's when they went to $1 trillion. They went to $1,200 a share or something. He said, "I don't understand why valuation is changing. We have a supply issue, not a demand issue."
That's true.
He is when this kind of stuff happens, he's very realistic about it.
Yeah, that's true. So, Paul, you were going to get back to the 8 pillars. My apologies.
Well, that's okay. I think it was a great point you bring up. And I think that, but the funny thing is, when the stock was at 150, not this 150, when it was 150 before the split, he said Tesla was overpriced.
Yes, he did.
And it still went 10 times higher.
That's why when I look at Elon, I'm just like, you're even realistic about your own thing. You're like, I don't get this, but whatever.
Well,
He's not
Paul,
gonna be able to control it.
I think he was doctoring his words back there, because if you recall, it wasn't that he said it was overpriced. He said the stock was too high, and thus he split it down to make it seem not as high.
No.
Oh,
No. This was like 5, 6, 7 years ago when he was like, the stock just seems a little overpriced here. Go look it up, because I remember him saying it. This was way long ago, and I was just like baffled. But anyways, next pillar, shares outstanding. Guys, I want you to understand something. When a company issues more shares, they are diluting you as an owner. This is very important. This is a silent killer of stocks. If a company has 100 shares outstanding and you own 10 of them, you own 10% of the business. If they issue 50 more shares, now instead of 100 shares, they have 150, but you still own 10 shares. So now you own 10 out of 150. Instead of 10% of the company, you now own 6.6% of the company. So let's look at Tesla. Scroll all the way to the bottom of the income statement in our exclusive software. 10 years ago, they had 527 million. Now they have 1 billion shares outstanding. This is not stock splits, guys. This already factors all the stock splits in. They've cut the ownership in half of every single owner from 10 years ago. In the last 5 years, they've diluted everybody by 25%. So what this means, guys, is even if the company is growing 20% over the last 5 years, which is doing better than that, but at some point, you're getting zero benefit from that because they're diluting the owners. And by the way, I don't blame them for issuing shares. Why? Because they're massively overpriced. They're like, oh, we're selling crack to crackheads. Let's just give them the crack.
Why take on debt?
Why take on debt? Let's just give them, sell them overpriced shares. That's the key indicator to me that a company realizes their shares are overpriced. They just keep issuing shares.
So I've seen, sorry, Mo, I was going to say, I've seen some news articles about the concept of some major CEOs are selling off shares of their own company. And is this some sort of sign that they see the writing on the wall?
Mohnish makes a very good point. I've read this in many value investing books. CEOs only buy shares for one reason, to make money, but they sell shares for 1,000 reasons. And that's a very important point in many value investing books. They'll sell shares for a ton of reasons.
Even listen to why we had no clue why Mohnish sold his Baba. We found out in the interview why. And it was not anything that I was thinking of. I don't think it was anything you were thinking of or you were thinking of.
No, not really.
No, it was what he said, because somebody said it, he said in an interview before, they like 10 cents more.
Correct. But the reason that he sold Baba.
With the watch the video.
Exactly.
Watch the video and he explains exactly
on my
why.
Radar.
Yeah.
Do you want to talk about Tesla's debt?
Yeah, let's talk about their debt. What kind of debt do they have? Well, we can't compare it to free cash flow because they have no free cash flow. Right? So let's go to the balance sheet. Long-term liabilities, $11.9 billion. That seems very reasonable for a company that does $46 billion a year in revenue. Okay. Am I right or wrong? I don't know, because what we do here usually is we compare it to 5-year free cash flow. And you'll see in the next slide, there is no 5-year free cash flow. Over the last 5 years, the average free cash flow has been negative. But the good news is they have growing free cash flow. They lost $5 billion 5 years ago. They made $2.5 billion in free cash flow last year. And it's getting better. So this is good. There's progress being made. So guys, here's the 8 pillars on the 8 pillars tab. I mean, it's just awful. Again, it doesn't mean you don't buy the company because of this. What we're going to do next is use the most important part of our software, which is the stock analyzer tool. All of our users who buy the software love this tool because what it does is it tells them what they should pay for a company's stock price today based on the assumptions for the future. So let's go put in our assumptions for the future for Tesla. Stock analyzer. So we think Tesla's going to be around for 10 years. Let's put a 10-year analysis in there. All right. Give me some revenue growth numbers, kids. Actually, let's do this. Can somebody Google and figure out what the 10-year growth projections are for Tesla? Okay. So we're not finding anything on 10-year assumptions for revenue growth, but let's do this. Let's say they're able to sell 10 million cars a year in 10 years. Okay. 10 million cars a year. How much is the average car going to be? What's the average sale price of a car today for Tesla?
40,000.
But for them to sell for Tesla or in general?
Tesla.
Okay, so for them to sell 10 million cars, they can't have really high-end cars. It's got to go more to the average. So
I think the Tesla bulls are saying they're going to come out with this $25,000 car and not have a ton of competition from something like a Apple or...
Okay, so right now, the average new car tops $45,000. This was just 2 months ago. Okay, so let's say in 10 years, it goes up 2.5% a year. So 1.025 to the power of 10 times 45. That would make the average car in 10 years $57,000 a year. Okay, so let's sit there and do that. 10 million cars times $57,600 per car is revenue of $576 billion. Okay, they currently do $45 billion. Is that what they do right now?
Revenue, yeah, 46.
So that is revenue growth of 29% a year on the high end. For them to sell 10 million cars a year at an average of $57,000 a car, it's 29% revenue growth per year. So high end, let's go 30. I'm going to go 10, 20, and 30%. How does that sound?
Okay.
Okay. Now, profit margin. I'm going to go 5, 7, and 9 because it's still above today at 9, assuming they have really good way of making more money than the average car company, even though the average car company now does 4 or 5%, and they're doing 7 with government money. So that seems reasonable. And I'm going to do the same thing for free cash flow. PE. Guys, I'm going to go, when the company's so large, 15, 20, and 25. I'm going to go, hey, all you like Tesla bulls, 25. If you don't believe this PE, if you already think that PE is too low, do me a favor. Unsubscribe, close the thing, write down under there, Paul, you're an idiot, and just move on. Because if you believe that the largest car company in the world should be selling for 25 times earnings when they're the largest car company in the world, you're nuts. And we're going to do the same thing for free cash flow.
Or uninformed.
No, you're nuts.
Okay.
And finally, guys, you want a desired return of 12.5% because you can buy an ETF and make 9 or 10. Let's get 12.5. Hit the analyze button.
So we should be paying what price if we want to make 12.5 per year?
Based on Tesla selling 10 million cars a year at $57,000 a car in 10 years, $488 per share. So it's double where it should be. If you assume 20% revenue growth over the next 10 years, still makes them a very large company, but probably selling 5 million cars at 4 or 5 million cars a year, you got to pay $153. 10% revenue growth a year, which is still pretty reasonable, $44 a share. It's currently at $940, guys. So even if they sell 10 million cars a year in 10 years, with all their issues, all that stuff, it still doesn't make sense at 48. So what does the revenue growth have to be in order for them to justify current price today? Let's put 40% in. Yep, 40%. So they've got to go and doing the same math, guys. 40% revenue growth times 40, what was it, $46 billion a year?
Yep.
Times $1 billion divided by $57,000 a car. They have to sell 23 million cars a year to justify today's price and all those other assumptions. They've got to sell 23 million cars per year in 10 years. The current international market gets a little over 50 million new cars a year currently. Will that grow? That will grow in 10 years. But let's say it goes to 60 million cars a year. They're going to sell over 1 out of every 3 cars in the year. Is that possible? Absolutely, it's possible. And by the way, in that time period, they never once issued more shares. They never once issued more shares. So they have the same number of shares outstanding. And you still have to assume they're going to grow 40% a year for the next 10 years. If you think that is reasonable.
Well, without a recession, Paul, where people maybe...
Forget about that. Forget about the recession. The world just keeps growing and does amazing. Just does amazing. And there's never any fallbacks. And by the way, in the last 10 years, there have been no problems whatsoever. The country has been, boom.
Peachy keen.
Peachy keen. By the way, from 2000 to 2010, we had a terrorist attack. We had a financial crisis and a housing bubble. That's okay. But the next 10 years, it'll be nothing's going to go wrong.
Clear sailing. Everything's
going to be fine. If you believe 40% revenue growth a year with margins double what they are in other car companies and with a PE of 25. Remember, PEs are justifiable on higher growth companies. And if you think they're going to grow 40% a year when they have half a $1 trillion in revenue, I just don't get that. It just doesn't make any sense to me.
And if you're watching other YouTubers out there telling you, well, they're going to do this, they're going to do the robot taxis, they're going to do the home robots, they're going to do the $25,000 car. we just sort of remind you they might not do any of those. They say they might, the tunnels and all the stuff, but they might not do it.
Responsible investing is about being conservative and still buying underneath the conservative numbers. 40% revenue growth for Tesla is not a conservative number. It is not. Do I think 10 to 20% is? Yeah, I do. I do think they'll grow over 10% a year for the next 10 years.
And Seth, to your point, the solar thing that they were supposed to do, now it's being investigated by the SEC. So it's
why? Because he bought a company from his cousin.
Yeah, something like that. But it's just more of like, they're going to do this. They're going to do this. They're not doing solar right now. So
yeah, remember when they were going to make a roadster and a truck?
$250,000 down payment. You're buying the car. And that happened, what, 2-3 years ago?
Yeah, they used to do where if you would refer a car, you could get a referral. If you got 50 referrals, you got a free roadster. But there's a guy on YouTube that got it.
He got two?
He has over 100 referrals, so he's in line to get two, but they're never making that car. I mean, come on.
Kim Java, she got it too. She's like, I don't.
Well, they might make the car.
Of course, they're probably going to make it.
Just like the internet changed the world. Well, the internet might change. No, the internet did change the world, and a lot of companies went under still. And by the way, guys, I'm not saying Tesla's going under. They're probably not going under. Not. Although he said in the last 5 years, they were 2 weeks away from bankruptcy twice. Yeah. But either way, these assumptions make sense to you. 40%, 9% profit, and 25 times earnings. Yeah, buy it all day. Congratulations. I will see you when it's selling for a lot less at some point in the future.
If this speaks to you looking at the numbers and making what we think are conservative assumptions moving forward, welcome to the world of value investing. If it doesn't, then we'll see you when everything crashes. We'll see.
The reason we created the software was exactly for this, because people watch the videos, want to do their own analysis when they see me do this. So we created the software so people could do this. You get everything you see here on the Everything Money channel, on the Everything Money page, all our tools, plus all the ones coming up. You get over 30 years of financial data. You get access to Seth, Mo, and I. You get all the 8-pillar analysis, that stock analyzer tool, real estate calculator, retirement calculator, 8-pillar portfolio. We can put in 50 stocks at once. It tells you how they all look as a portfolio. All of this plus exclusive daily content. We have 1, 2, 3 videos a day that we release only to our users of our software. You get it all in mobile form. All of this is available on your mobile app, all for only 90 cents per day. 90 cents per day. If you can increase your returns or decrease your losses by 1 or 2% a year, that could lead to hundreds of thousands, even millions of dollars in extra net worth for only 90 cents a day. 2 ways to sign up, everythingmoney.com or Patreon. The benefit of everythingmoney.com directly is you don't pay sales tax yet because we're not big enough. So sign up, only 90 cents a day. This is a no-brainer, less than a cup of coffee.
Fondle thumbs up. We will certainly update you what happens with when this stock changes. But that's our take on Tesla. See you next video.